How does the economy work? How does investing work? Everything works similarly. You take data and then you plot that data and you try to make a thesis, a hypothesis, and an educated guess in where you're going to allocate your funds. Right now, we are in a recession. We also have very high inflation. We also have very high employment. There's reports that come out monthly, some are quarterly, some are annually, so on and so forth. At the end of this month, on August 24th at 10 a.m., we will get the jobs report. I will be filming it live on this channel. In the meantime, today we had something called the Jolts report. What exactly is the Jolts report? Jolts stands for Job Openings and Labor Turnover Survey, and it essentially shows you how much opportunity there is for job openings. That doesn't necessarily correlate to how much people are looking for work, but it is a good lagging indicator of what's to come. You remember when Joe Biden says and when Jerome Powell says that there is a 1.9 to 1 ratio of job openings to people looking for jobs, which means for every one person that's looking for a job, there's 1.9 job openings. Well, this number actually contracted right now, and that's a good thing. Why? You want a 1-to-1 measure, and that's a healthy economy by all people's perspective. Now, by the job openings getting less, that means that our economy is shrinking and higher inflation is possibly going to go down, and raising interest rates happen to be working. The Federal Reserve, they can only control demand. They cannot control supply. By controlling the demand, they actually want people to get laid off, fired, and not working at all. 1.9 to 1 means that there's a strong labor market and that the economy can take a lot more abuse, which means you can raise interest rates and raise them and raise them. Now, Wall Street sees the Jolts report as something positive. Remember, what's bad for the economy is good for Wall Street, and what's good for the economy is not necessarily good for Wall Street. Take a look at this article from Wall Street Journal, and I wanted to show you some quick numbers and mathematics. Now, this is from Wall Street Journal. I pay for Wall Street Journal so you don't have to. So in the meantime, I would definitely appreciate if you could give me a like, a share, and subscribe because I pay for all these publications. If you want to read the actual Jolts report, I will leave a link to it in the description down below. I did read through it. It's pretty boring. Demand for workers falls to lowest level in 9 months. U.S. job openings fell in June for their lowest level in 9 months. Hiring slowed and the signs of a cooling labor market. Remember, a cooling labor market means people are out of work. If people are out of work, that means they have less money to buy things. As they have less money to buy things, prices are going to go down because there's no more bottlenecking because supply and demand. The supplies cannot increase, but you can cool down the demand to increase the supplies for later on. And this is exactly what's happening when people get out of work. Eventually, interest rates will start going back down, and that will then ramp up the economy. Now, this is all lagging. Keep that in mind, and things take time. This is going to go on for the next 6 months or so. It doesn't mean that things are changing in a daily pace. The Labor Department on Tuesday said there was a seasonally adjusted 10.7 million job openings in June, down from 11.3 million in May. So in May, they were expecting like 11 million. They actually got 11.3 million. This month, we're expecting 11 million, and we actually got 10.7 million. You see, because the numbers didn't change significantly, but definitely did change, this is good. This is not a panic. That means that everything is going according to plan, if you ask me from my personal point of view. This is an extremely interesting chart over here. The blue is the unemployed but seeking work, and the beige is the job openings. What you want is this to cross, and then you have a 1-to-1. It doesn't let me click on it really, but if you look at last month, we had approximately 11.3 million openings, and we had 5.9 people looking for jobs. Now we have 10.7 million openings, and we still have the same 5.9 million people looking for jobs until the next jobs report. Let's do quick math. If you take 11.3 million and you divide it by 5.9, you're going to get a number of 1.9. That's where Jerome Powell has 1.9 to 1, right? Let's redo the math now. But now you have 10.7, and you divide 10.7 by the same 5.9, and now you have 1.8. If you do the math again, 100 divided by 1.9 equals, and then if you times it by 1.8, that means that we have a reduction of around 5%. Doesn't seem like a big deal, but it most certainly is. This is the price of crude oil. I have been following it on this channel for the last several months, just like I've been covering the prices of gas. As you see, for the last 5 days, crude oil is still down. This is a fluctuating price between $94 and $97. For the last month, crude oil is down 12%. For the last 6 months, we are only 7% above where we were 6 months ago. And for the year, we are now only 33% above where the price was before. If you do look for the 1 year, right around here in June 9th, the price of gas was around $122 a barrel. It significantly dropped, and I believe that is the peak of gas prices. Let me show you one more thing. This is the national average of gas. I've been following this for the last 2 months or so. The current national average was $4.18. Yesterday was $4.21. Before that, it was $4.28. You might not feel that, but if you go from a week ago, 418 to 432, you start feeling a little bit of a difference. Now, if you take 418 and you look a month ago was $4.82, you see a difference. When I started tracking this, the average national gas price for a gallon was $5.01. Currently, it's $4.18. That is a pretty nice reduction. That is approximately a 17% reduction in gas prices. When I first started tracking this, it was 10%, then it became 11%, 12%, so on and so forth, and now it's nearly 17%. These are things that you actually see. These are things that actually affect you in the economy. Again, everything is a lagging indicator. For example, the jobs and the Jolts and the CPI and the GDP, so on and so forth. Somebody in my live earlier today said, hey, Adam, the economy is just getting bad for Germany, or the economy is just getting bad for Europe. I'm sorry, the crisis is just starting. And I said, no, that is a terrible way to invest, and you need to change the way that you're thinking. If you think the economy, the crisis is just happening, you are severely, severely mistaken. The crisis actually started around 6 months ago in the beginning of the year. You're only now starting to feel it because everything is, again, a lagging indicator. And I'm going to keep saying this. On my channel, we knew about the recession or predicted it 3 months ago. We've been doing a bang-up job. Thank you for all the supporters. Like, share, and subscribe. By the time people are going to realize that the economy is bad, the economy is actually changing for the better. So right now, people are just starting to notice the recession and the inflation, so on and so forth. But with all the data that I'm seeing, and it can change daily, guys. I'm just giving you the data as I see it right now. You can see that the economy is actually starting to turn in the right direction. And when I say the right direction, I mean good for the stock market. This is going to keep happening until the end of the year. I believe starting next year in second quarter, third quarter, and second half, the economy is actually going to start going back up in terms of the stock market, because I do believe that there's going to be a reduction in interest rates by the Federal Reserves. And this is when there's going to be a massive bull run, and a lot of people are going to be making a lot of money, specifically the people that are paying attention and understand what lagging indicators are and paying attention to crude oil, Jolts, job report, GDP, consumer sentiment, all these things that I'm covering on this channel. I know it's boring, but I think I'm starting to grow a core group of people that follow my channel for not some brainless, stupid shit to the moon type of YouTube videos. I hope you guys are enjoying this type of content that most other YouTubers are not going over, because most other YouTubers, especially the finance gurus, don't know F about shit when it comes to investing, and they don't even know that this type of data exists. Thank you and have a great day.